Let's jump right in. Welcome to today's explainer. Okay, picture this. You finally decide to, do the responsible thing. You start saving money every single month. You move a little bit into your savings account. Maybe $100 here, $200 there. And honestly, you feel pretty good about it. You feel responsible, disciplined, financially mature. But there is a core paradox we really need to address today, because doing that responsible thing, just saving money, might actually be the exact thing holding you back from building real wealth.
So here's the reality check. One day, you open up your banking app on your phone, you look at your balance, and you realize something kind of strange. You have $10,000 sitting there in a typical savings account, and it's earning something like, 0.5% interest. Do the math on that. That means after an entire year of being incredibly disciplined, you've made a measly $50. But wait, if inflation was, say, 3%, your money actually lost purchasing power. You are literally moving backward. Meanwhile, everywhere you look, you keep hearing people talk about stocks, index funds, and compound growth.
Suddenly, you start wondering this exact question. Am I doing saving wrong? It's a frustrating feeling, right? You've got the discipline, you have the financial maturity, and look, saving money is inherently a good thing. But we have to challenge this strategy today because saving alone rarely builds real wealth. It's fantastic for stability, sure, but it is absolutely not the engine for growth. A lot of people get stuck right here. They know saving is important, but they have absolutely no idea how to safely transition from saving to investing without feeling totally overwhelmed or risking their financial security.
So here is our roadmap for today. 1. The savings trap. 2. Why investing builds wealth. 3. Overcoming the psychological barrier. 4. The 5-step path. And 5. The magic of compounding.
Okay, Section 1. The savings trap, or why saving alone rarely builds real wealth.
Let's start with a truth that might sound a little controversial at first. Saving money alone will almost never make you wealthy. Now, don't get me wrong, saving is absolutely crucial, but it's not the final goal. It's literally just stage 1. See, these are two completely different jobs for your money. Savings are designed to protect your money, while investments are designed to grow your money. You wouldn't use a hammer to drive a screw, right? In the exact same way, you can't use a savings account and expect it to do the heavy lifting of an investment account.
Moving on to Section 2, why investing builds wealth, and the math of wealth creation.
So the crucial point here is understanding the cold, hard, mathematical necessity of investing. Let's establish a baseline. Imagine you save 10 grand in a typical savings account earning 1% interest. After 1 year, you have $10,100. Hey, not terrible, right? But let's compare that with investing. Historically, the S&P 500 stock market has returned about 10% per year on average over long periods. If that same $10,000 earned 10% annually, after 1 year, you'd have $11,000. Now, I know what you're thinking. In year 1, that difference might not seem earth-shattering.
But man, here is the massive wealth gap most people completely fail to realize. The real magic is compounding over time. Over a 20-year timeline, if you leave that money in savings at 1%, it grows to about $12,200. But investing it at 10%, that equals about $67,000. That's the exact same starting money, but a completely different outcome. The biggest wealth gap in society isn't usually between people who save and people who spend. No, it's between people who save and people who invest.
All right, Section 3. Overcoming the psychological barrier, specifically the fear of volatility.
We really have to acknowledge the elephant in the room here. The reason people don't make the transition from saving to investing isn't because they can't do the math. The math is easy. It's psychology. Saving feels safe. Investing feels risky. When your money is in a savings account, it doesn't just drop 5% on a random Tuesday afternoon. But investments move. They go up, they go down, and that emotional volatility really scares people. But think about it like this. Saving money is kind of like storing seeds in a glass jar. You are perfectly protecting them, sure, but absolutely nothing is going to grow. Investing, on the other hand, is like taking those seeds out of the jar and planting them in the dirt. At first, it looks messy, you don't see results immediately, but over time, things grow, and eventually you have a harvest far bigger than those original seeds. You just have to be willing to get a little messy to see that growth.
Which brings us to Section 4, the 5-step path, transitioning from saver to investor safely.
Now, you might be thinking, I really don't want to lose my hard-earned savings. That is totally fair. And it's exactly why this transition should happen in gradual stages, not all at once. Here's the overarching 5-step path. Step 1 is the absolute foundation. Build a real emergency fund. Before you invest a single dollar, you need 3 to 6 months of living expenses saved in cash. This money stays in savings. It's for unexpected problems like a job loss or your car breaking down. Why? Because the biggest reason people panic sell their investments is because they suddenly need the cash. An emergency fund literally protects your investments from your own life. Once that's built, you can move on to step 2, separating your money mentally. Then step 3, starting small, maybe just $50 or $100 to build a habit. Step 4, using simple investments. And step 5, staying disciplined.
Let's dive a little deeper into step 2 because this one is huge. You need to separate saving from investing mentally. I want you to think of your finances as 2 totally different buckets. Bucket 1 is your safety money. Bucket 2 is your growth money. Your safety money, that doesn't move. But your growth money, you have to give it permission to fluctuate because its literal job is to grow over time. Establishing this mental separation dramatically reduces your anxiety, ensuring that when the market inevitably does dip, you don't panic and hit that sell button.
And how do you actually invest that growth money? Well, step 4 of our path is all about keeping it simple. Beginners often make this massive mistake of jumping straight into super complicated strategies, day trading, options, crypto speculation. But simple investments almost always outperform the complicated ones. Index funds, for example, just track the overall stock market. So instead of trying to pick one winning company, you invest in hundreds of companies all at once. It's diversified, it lowers risk, and it provides steady long-term growth. It's actually so effective that legendary investor Warren Buffett has repeatedly recommended low-cost index funds for most investors.
Now for section 5, the magic of compounding or letting the market do the heavy lifting. I want you to consider the most powerful yet wonderfully boring investing strategy in the world. Consistent investing. Let's break down a really staggering example here. Imagine you invest just $300 a month into the stock market. If the market averages an 8% return per year, after 25 years, you'd have roughly $285,000. But here is the crazy part. You only actually contributed $90,000 out of your own pocket. The rest of it, almost $195,000, comes purely from investment growth. That is compounding working in your favor. The market is literally doing more than double the heavy lifting for you.
But psychology still matters here, because investing will feel uncomfortable at times. You might be asking, well, what if I start investing and the market crashes? It's a great question, because market crashes are completely normal. They've happened dozens of times throughout history. But here is the key insight. Long-term investors actually benefit from downturns. When markets drop, your monthly investments are now buying more shares at lower prices. It's literally like the stock market goes on sale. This often leads to even stronger returns when the markets eventually recover. This is exactly why experienced investors stay so calm during volatility. They're thinking in decades, not days.
So let's summarize the core takeaways from today's explainer. The step-by-step path is pretty clear. First, build a 3 to 6 month emergency fund to protect yourself. Second, mentally separate your money into safety money and growth money. Third, start investing small amounts consistently to build the habit. Fourth, focus on simple, long-term investments like index funds rather than gambling on day trading. And fifth, stay disciplined and give compounding the decades it needs to really work its magic. Remember, saving money gives you stability, but investing gives you freedom. The earlier you combine both of those, the more powerful your financial future becomes.
I want to leave you with a final thought to reflect on as you look at your own financial journey. Based on everything we've unpacked today about the limits of the savings trap and the absolute mathematical necessity of true wealth creation, ask yourself, are you currently in the saving stage, or have you already made the leap into the investing stage? It's never too late to take the next step. Thanks for joining me on this explainer, and I'll see you next time.